In this video, we are going to talk about sources and costs of capital. We've learned in our discussions on the balance sheet that we can take the accounting balance sheet and we can rework it so it moves from talking about assets and liabilities towards talking about capital and operations. So as we think of that balance sheet from a business perspective, the capital comes from two primary sources. It comes from shareholders who provide us with equity and some financial institutions that provide us with debt funding. Our two primary sources of capital, shareholders and debt providers. We put that capital to work in the operations where we might purchase some fixed assets, property, plant, equipment, machinery, etc., in order to manufacture a product that we might sell to some customers, and we make use of some short-term capital, stock on the shelf, cash in the bank, that help us in this business process. And the purpose of this video is to explore these sources of capital, these shareholders and debt providers, and understand the expectations of those different providers and what they want as a return on their capital. So let's start with the shareholders. What would a shareholder want as a return? Well, they want a dividend at some stage. That's the best way of getting a return. And if it's a listed company, then they would want to see the share price go up. And maybe a combination of both would be great. Share price growth, dividend income, and those would measure the total returns that a shareholder would get. Now, a shareholder is only going to get those returns if a business performs well and is able to meet all its other financial obligations so that there is capital left over for reinvestment and payment to the shareholders in the form of a dividend. The debt providers, for them, the performance of the business is not as important when it comes to profitability. The debt providers, they just want the interest that's due on the debt and the repayment of the capital, and therefore sufficient profitability to meet those obligations is really all they're looking for. Because the debt providers, they're actually not taking the same risk as the shareholder. Their risk is that they lose their capital, and they just want to get the interest and capital back, and they want the business to remain sustainable. In order to do that, they don't want additional profits. That is for the benefit of shareholders only. So let's spend a moment looking at this chart that tells us about the historical performance of the All Share Index as measured by the Johannesburg Stock Exchange. So this All Share Index consists of approximately 160 shares on the JSE. Those shares are based on the size of the company as measured by the value of the equity. And to measure the value of the equity, we use something called the market cap, which is the number of issued shares multiplied by the share price. So we would be able to get a list of companies on the JSE based on their market cap, and effectively the top 160 companies would make up around about 99% of the total value of all the companies listed on the JSE, which is approximately 400. So these 160 companies in 1980, which is where my data in this chart starts from, were very different companies to what they are current day. So of course the companies change over time, and we readjust the index on a regular basis in order to suit the current data. So what we can see here over time is that there's times when the market gets stretched to the upside. You might say like an elastic band, it's in a stretched position and it wants to mean revert to the norm, and sometimes that mean reversion is a quite violent emotional response in the markets. We sometimes call it a market crash or a market correction, and we can see there are several of these going on from time to time. And in fact, as I'm doing this video, we have recently experienced a significant decline in the all share index. Now, I'm interested not in the granular detail along this journey, but more the overall picture that tells me that this data has produced cumulative average returns to shareholders of 18% over this duration. So that's a combination of two things. It's a combination of the share price going up and shareholders receiving returns. Now, of late on the JSE, certainly over the last 5 years, these returns have been much lower, and they're starting to put pressure on this long-term average. But for now, we're going to use 18% as our expected returns for shareholders based on historical information from the all share index. If we look at the debt providers, we can go and find some information about the repo rate and the prime rate in South Africa, going back, in this case I'm going back to 2004, and we can see how is the repo rate, the rate at which the Reserve Bank lends to the major consumer banks in South Africa, or major retail banks. And here we can follow the line, and we can see back here in 2012 and 13 the repo rate was at 5%. It's gone up, it's come down a little bit, and currently it's at 5.5 percentage points. And what happens is when the banks borrow at that rate from the Reserve Bank, they add 3.5 percentage points, which is effectively their profit margin, so that they lend out to you and I at the prime rate. Now, of course, not everyone gets to borrow at the prime rate. That's up to the bank's discretion. But for the purpose of this example, I'm going to assume that the current cost of debt in South Africa is 9%. So now let's come back to our balance sheet. Here we have the capital coming from shareholders that expect a return of 18%. Here we have capital coming from the banks, etc. And these banks expect a return, and with the recent change in the repo rate, that number is now a return of 6.5%. So let me clarify and correct that. The banks expect a return, or expect individuals and businesses to pay 9% on their debt. That's if you're borrowing at the prime rate. However, one of the benefits of borrowing money and having an interest expense in the income statement is the interest is tax deductible. So that has a benefit for a business in that we pay less tax because we have interest. And as a result, we can make an adjustment to the cost of the debt down from 9% to 6.5%. And I'll show you that calculation and how the maths works around that in a moment. So for now, let's recognize that we've got equity at a cost of 18% and we've got debt at a cost of 6.5%. Now, I'm assuming that for our business, we're going to use an optimal capital structure of 70% equity and 30% debt. So I use the term optimal capital structure because we've got some equity and some debt, but not too much debt. Remember, debt brings interest expenses, which are fixed costs, which bring risk to the business. But we've got some debt because there's a tax advantage. So it turns out that 70-30 is an optimal balance between the two. And when we calculate the average cost of this capital, it turns out to come to around about 15%. We call this number our weighted average cost of capital. Weighted average because it's weighted according to 70-30, and it's a cost of capital because it's using these two costs that those capital providers expect as a return. So let me move on here to some Excel calculations, and I'll put some numbers together and I'll explain the calculations to you. So here under equity, I'm using the 18% that we got from the historical data. Under debt, I'm starting with the 9%, which is the current prime lending rate. And here our tax rate is at 28% in South Africa. So I'm doing a little calculation which says take the 9% and multiply it by 1 minus 28%. So that's the same as saying 9% times 0.72. That gets us to 6,48. You might say that's 6.5%. And that was the number that I used to calculate WACC. Now I'm saying there's 70% of our capital is in the form of equity, 30% is in the form of debt. Now let's calculate an average here. What is 70% of 18? I've simply multiplied those two together. And here, what is 30% of 6,48 to get that proportion? And once we've got the proportions of the two sources of capital, we can add them together. And that number turns out to be 14,54, and I've simply asked Excel to round it so that we end up at 15%. And that's a rough estimate of the cost of capital of companies in South Africa. It's the expectation of return that these companies require. And if you remember, we did some calculations under the measurement of performance in a business where we measured RONA, and in principle RONA should be greater than our weighted average cost of capital. So we know that we need to generate returns that are higher than 15% in order for us to generate value for the business. We also did some calculations called return on equity. And here we learned that these numbers, the return on equity, must be higher than 18% because that's an historical expectation that shareholders have had in the business. All right, so what have we done in this video? We've identified sources of capital. We've done the calculations in order to calculate WACC so that we can use this cost of capital in our business. And I'm going to show you an example in an upcoming video on how to use WACC to discount future cash flows. Remember that time value of money concept. We'll see you in the next video.